almost all commercial banks would apply, would do cash flow loans, but not all companies would be qualified for cash flow loans. So kind of first thing we need to discuss is, okay, every company has an enterprise value, every company has EBITDA. What is kind of the threshold where it becomes interesting or applicable for cash flow structures? So for most banks, a company needs to have, 8 to 10 million of sustainable EBITDA. That's kind of the cutoff nowadays for most of the banks. It's kind of the rule of thumbs. Obviously, there are exceptions. There are some non-bank lenders, SBICs, et cetera, that might end up doing cash flow deals for companies with EBITDA lower than that number. But the size of EBITDA is really, really important because that's one indicator or kind of early filter that lenders apply, because higher the company, higher the EBITDA, it indicates the company has a little bit more cushion in its cash flow to withstand some of the unpredictable bumps in the economy or in the business. So if the EBITDA is really small, they have much less cushion, and that increases the risk that company will survive. So that's kind of the very first cut, the size of the EBITDA. So commercial banks are obviously a big provider of this, but they tend to be conservative primarily because of their outlook and the way they need to operate their business, and secondly because of regulations. So almost all commercial banks, when they do cash flow transactions, typically they would lend no more than around 3 times EBITDA. That would be the amount that they can lend, and they would restrict the total debt to EBITDA ratio in a company at around 4 times. Again, there are exceptions to rules because every bank has a portfolio and they can do a couple of deals that can go beyond these thresholds. But on average, they would prefer to be under 3 times, and smaller the EBITDA, farther below 3 times they want to be. So that's kind of one way to think about that. But then there are probably hundreds of non-bank lenders that have cropped up over the last 15 years, many credit funds that end up doing many of these cash flow structures, and they are not regulated. They do not have any, regulatory requirements. So they approach risk on a very fundamental basis. So they may say, this company, while bank can give 3 times the leverage or 3 times EBITDA in that amount, we can give 4 times or 4.5 times. Again, depending on the credit. But the way to look at that is typically banks would want to be around 50% of the enterprise value, not much more than that. Non-bank lenders can go all the way up to 70% of enterprise value. So if you're, let's say, for round numbers, if the enterprise value of the company, was around 8 times, a non-bank lender can give about, 5 times, 5.5 times leverage at max for the right condition, for the right company and right sponsorship, versus a bank would, always stop at around 3 times. So if you wanted more capital, then non-bank lenders can provide that for a particular cost.